Let's get down Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's tax-advantaged income with life insurance. And on today's show, qualified plan and life insurance expenses. And with me today is Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist and consultant author to backroom technician. Let's get down to business. Well, welcome to the show, Ken.
Hey, Steve. Good to see you.
Oh, Ken, midweek, and I'm heading for my wheelhouse gripe. Oh, my goodness. I'm going to try to be good today, but it's going to be tough. Let's talk about expenses and qualified plan. Now, people say, why are you bringing this up, Steve? Because everybody always nags us about the expenses and the life insurance. I've been Mr. Disclosure for the last 25 years of my 30 years. You met me in the early days. I was all over these issues of disclaiming and disclosing to clients exactly what's going on and the costs. But before we do that, I just want to remind everybody, about a year ago, we got a new reg of compliance called 408B2. We're supposed to look at qualified plans, full disclosure on setup, admin fees, RIA charges. We're supposed to look at the funds fees, and of course they neglected to throw in again, I'm sorry to say, the statement of additional information. So that's all in. When I look at that, I'm looking at some numbers here. Now I find it curious, and I'm asking you, CPA. When a CPA looks at the expense loads, and if I told you we're sitting anywhere between 330 and some plans are almost at 400 basis points every year, does that bother you as a CPA defending his client in looking at a qualified plan that has expenditures? Now, by the way, a little fair distribution, a little balance, fairness. 401k price tags have come down because of the 408B2. I'm not going to say it hasn't, it has.
Well, they also had come down before that hit. They used to be much larger than they are today.
A lot of competition.
Sure.
So talk a little bit about each expense. Let's talk about the actual, hey, they have to send out an annual letter. Somebody's got to pay for all this admin. That's an expense load.
Well, it's kind of interesting, and I became aware of this early in my career in the early 80s, is there was some mutual fund companies out there that sold a ton of their mutual funds through 401ks, and I always wondered, well, why? They're kind of dog meat returns, and they don't have a good history. Well, they were smart enough to recognize that they were just passing on the cost of administration funding to the employee. And of course, the employer looks at it and said, well, yeah, we're kind of forced to do this in order to have our own 401k plans. Government says if I don't take care of them, I can't put enough money away for myself. So then I start putting in matches and all this other stuff. Well, employers need to recover some of those costs for benefits. I actually had an employer one day said, I won't put a 401k plan. I said, why not? He said, because I would have to reduce my employees' compensation in order to make a profit, and then they'd run down the street to somebody else that'll pay them more that doesn't have a 401k plan. So there's actually good reason why those expenses are there, but nobody really knew about them, and everybody thought this was wonderful and didn't consider how do you make money after all this load.
One of the numbers that I was looking at the difference because all products have expense loads.
Of course.
Nobody's exempt. So I'm always trying to look at who has the least expense loads and do they still give a quality product. Remember, if you pay a little bit more in expenses and you're getting a quality return, maybe you don't care.
Right.
It's a value proposition all the time when you're talking expenses.
Right.
But Ken, when I'm looking at it, when I look at the number, I have no problem disclosing, and we're going to do this in the second segment, the life insurance expense loads, but I've always been, the normal kind of gripe out online is that ours is so much and it's so expensive. In the second half, we're going to get to that. But when I'm looking at total expenses, I'm looking at also, IRA fees go up every year, if the assets are going up.
Yep.
And so what I did was I took all the expenses for everything, setup fee, admin charges, the registered investment advisory charge, and it's increasing charges every year on the AUM, and I'm looking at the fund issues, and I'm including what I call not in the prospectus, the secret ballot called the statement of additional information, which I'm so sorry to say, somewhere around 85 to 90 basis points, and it's not anywhere in any of these disclosures.
Well, and if somebody is savvy enough to order a statement of additional information, which is available and offered from all the mutual funds, and they look at it, it isn't that nice little sweet table where it says, okay, this percentage for this fee and that percentage for that fee, and it's all laid out and it's really easy to say, oh, okay, that's what it costs. It's buried in the paragraphs. You have to pick this little piece here, and this, at least the ones I've seen, little piece here and add it up, so they make you work for it too. So it is buried.
Well, think about it. At least with the 408B2 compliance now, we can see it. They do a kind of a digest, kind of a summary statement,
Right.
and I think that's great. We really get to see what's going on. I guess what I'm coming to is when I compare the expense loads of qualified plans, I don't really see myself being that much more to do what I want to do with cash value life insurance. That's my whole point.
Well, and beyond expenses is liability. How many small business owners that put 401k plans in place understand that every single penny of their personal assets is at risk? In other words, if that qualified plan blows up because it wasn't administered correctly, it's no longer qualified and there's taxes due, or if the portfolios don't perform, if they didn't take care of their investment policy statement and make sure there is quality assets in there, and there's trouble and their employees want to assume, it's their personal assets on the line, not the assets of the trust, not the assets of the corporation or their LLC that they put in place to protect themselves. Their personal assets are on the line.
I mean, think about it. I think you're alluding to 404C, the compliance issues. Let me tell you, we just got 408B2 online for the last year. That's just disclosure. This is compliance and how you fit inside the regulations of doing a qualified plan. When we come back from the break, we're going to talk about the impact of policy expenses on life insurance performance and include the deferral accumulations and the tax-free distributions. Social Security benefit taxation, and how to optimize the strategy to make your tax-free income really tax-free. And don't forget, you can request our show documents, the ones we use on the show, as sample examples from Backroom Technician at ashbrokerage.com. And remember, you can sign up for your home 30-day free trial offer on Backroom Technician. Just go out to their site, www.brtnow.com/trialsignup.aspx. We'll be right back after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back. I'm Steve Savant with Ken Davis. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, at www.ashbrokerage.com. Just click on the show logo at the front homepage. It'll take you right out there. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, your legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about the impact now of life insurance expenses. We have expenses too.
Sure.
I mean, let's just be fair. And every illustration that I publish does two things. And by the way, Ken and I have been demanding this, I'm going to say going on 25 years. We've been together for so long, and we ask and demand every proposal to have the internal rate of return on cash value and death benefit, as well as the expense report. Now, here's my only gripe before I get into the rest of this. I can do that with every product except participating whole life. Somehow, it's still in the black box. I haven't been able to unbundle it. I haven't been able to unpack it. Someday, before I retire, I'm hoping that we'll see full disclosure on participating whole life, because remember, for conservative savers who like guarantees, that could be part of their cash value life. Instead of doing indexing or current assumption interest rates, they may like the conservatism. But how do I know what I'm getting?
Well, and I think we want to make sure our viewers understand. We are not dinging securities today. We're just making sure that everybody knows the true costs. And so often we see that even a lot of advisors we know that are quite sharp folks really hadn't stopped and think about the SAI and what it does. And we're at the same time, we're just as strongly wanting to expose expenses on the life insurance. And I would also say this. In the earlier years, life insurance does very poorly on a liquidation basis and is not a good place for short-run periods of time. For long-term strategies, when you start looking at fee expenses comparison, life insurance really starts to shine.
if this is done right, the crossover year could be around, and remember this is going to be varied between client to client and what they're contributing, but the regular crossover period, probably somewhere around 8 to 9 years. Somewhere in that vicinity, all of a sudden we're even money. We haven't recaptured, we're just even money. Then another 2 to 3 years, all of a sudden we start becoming better. And if you do this right, as we've talked about it many times before, the distribution cost, our target is somewhere around 100 basis points. It's going to be a little bit more, a little bit less, but our goal is to get distribution down to 100 basis points expense.
Well, and just as a tip for the agents out there listening to this, when you're looking at your illustrations and you start asking all your IMOs, if you're using other IMOs than ASH, ask them to run the internal rate of return and have ASH run it on the same company and then look at the internal rates of return. You may be surprised to see that it's better because they know how to squeeze it down.
I have to say, our illustrators and proposal in the proposal units really understand what we're trying to get done here. And we really recommend highly that if you get especially if we have clients, because remember we have consumers watching our show, even though it's a professional show, we always recommend let us look at it and make sure that it's the best possible suppression of the death benefit to make sure the cost of insurance is down that low. We really go after this.
Well, and we have to look at it the distribution phase too, because some policies will have true zero net cost loans, but others don't. And if you look at the fine print, even on the guaranteed page at the bottom, I've seen where they said we have the right to increase it by 200 basis points spread. And I go, oh my gosh, this is a guaranteed sheet and it has the numbers and it still get the fine print on the bottom.
Yeah, and don't forget the Friday show because that's going to be a major expose on policy loans. I'm going to be all over it. So I have no problem saying I do have front-end loads. I say it. I freely admit it. I have administration costs. I have the regular mortality charges. I have to pay those charges, right? I have a policy fee. And during those first 5 to 8 years, I am not going to beat a qualified plan total expenses. I'm going to lose that war. But the moment I cross into what I call midterm to long-term investors, midterm to long-term savers, when they start looking at this, this is when it becomes huge. And again, during distributions, because of tax-free withdrawals to basis and policy loans to gain, as long as the contract's kept in force for the life of the insured, it becomes a play.
Well, and the other thing I'll point out is the magic age of 59 and a half has no impact on life insurance. Yes, we have to worry about force-out rule if we take money in the earlier years, but if we take loans, we can take them well before 59 and a half. So in an emergency, and I think this is especially important for small business people who like to know that they have access to their cash in emergencies because they know that sometimes their businesses hit tough roads and they need to access cash.
Well, I used to really enjoy people who say, hey, I need to go before 59 and a half. And then what would we show? Well, we can go back to 55 at least, right? And the code will let you amortize that over your life expectancy. But I don't know if that's the way to go. Here you could get into your money a lot earlier, as you suggested, and I don't have the what I call the ERISA regs hanging over my head that I have to really watch over.
Well, and there's no limits on contribution either. If you really think about what a cash value life insurance policy is it functions similarly in many aspects to a Roth concept. No deduction up front, tax deferral in between, tax-free distributions if handled in place and the policy remains in force, and no taxes at death. Unlike a Roth IRA, we have no 59 and a half magic number. There is no 10% penalty on the earnings. I don't have to keep it in there for 5 years. And I have no front-end limitations on how much premium I pay. Obviously, underwriting has some impact on that, but there's no federal rules that limits how much I put in a life insurance policy.
Well, I love that because the advantage again there is, because a lot of people say to Roth or not to Roth. Should I Roth, should I life? And when I'm looking at the numbers, especially when I get young people under 50, I give them both ideas and bring up what you just said. Remember, we're still under regulations with the Roth of the points that you just brought up. So I want to always compare and try to be fair with that and show both sides of the equation. And then also, by the way, and I don't want to get into it now, but also the beta risk if we're doing something on the other side.
You know, in particular, business owners are illiquid. Their money's in their business and real estate and land, equipment, whatever. They're wealthy on paper, but they don't have liquidity. This gives them access and liquidity that they normally wouldn't have.
Well, that's our show for today. I want to remind you that you can read all my online insurance news commentary, advisor blogs, and articles on Producer's Web, and all my answers to consumer questions on Insurance Library. And remember, you can watch all our shows on our on-demand section located at ashbrokerage.com. And don't forget, you can follow me on Twitter, Facebook, LinkedIn, or email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. See you tomorrow.